Hey guys, Cody Barton here. I want to answer the question, traditional mortgage versus seller finance or owner carry, seller carry back. Those are all just different versions of saying the same thing. And I just want to make this clear because this is a question that comes up time and time again. These are not very different. So on a traditional mortgage, for example, typically what people are going to be doing is think about your bank, whether it's Wells Fargo, Chase, Bank of America, maybe it's a credit union. If you go to them and you're going to get a loan on a property, what's going to happen? You're going to turn in your paperwork, they're going to run your credit, all these different things are going to happen. And then once you actually buy that property and you close escrow on it, you now own the property. You're now making mortgage payments. You're making payments to that bank, to Bank of America, I'm sending payments to every month, or Wells Fargo, I'm sending payments to every month because I got a loan with them. And the difference between this on a loan from Bank of America versus like the seller finance one is to Bank of America, here is what is included in that monthly payment. I'm paying my principal payments, I'm paying my interest, so there's an interest rate, so say your loan is 3% or 4 or 5% interest with the bank, you're paying the property taxes and then you're paying the insurance on that. So that's also known as PITI, so principal, interest, taxes, and insurance. And that could be accumulated to like a $1,200 a month payment. And that would be what you're paying on a traditional mortgage. Now let's move over to the seller carry side, or owner carry, right? So essentially, it's the same thing. My amazing cameraman here, Jesus, say he owns a property and he owns it free and clear. And maybe he's been renting it and there's tenants in it and he just doesn't want to be a landlord anymore. But he also doesn't want to, sell the property and, get a lump sum of cash and have to pay a bunch of taxes. So I make an agreement with Jesus that I say, hey, like, instead of you selling it for cash, what if I just, paid you a down payment and then I made monthly payments to you until it's paid off? And we agree and we're like, okay, well, I'll pay you, 4% or 5% interest, whatever that interest is. And now what am I doing? I'm doing the same thing I did with the bank, except now Jesus is the bank. The principal and interest payments that I'm paying are going to Jesus as part of what he gets, but then I'm also paying the taxes for the property taxes, and I'm also paying that insurance, that homeowner's insurance that protects the liability of the property. So there's not really many differences when you're comparing them to each other. It's just the agreement that I make with a homeowner that wants to sell or carry their property to me versus going to a traditional bank, and they aren't necessarily caring as much about what particular property it is. They're just, looking at giving you the loan for that amount, and I'm just making the payments directly to the bank instead of just an individual. So if you have any other questions on the kind of the difference between the traditional mortgage versus, the seller carry, put those in the comment section below. Happy to answer any questions on that. If you got any value from this, make sure to hit that notification bell. We'll see you in the next video.